So Manpreet Gill, Chief Investment Officer, Standard Chartered EMEA. Good to have you with us.
Thanks so much for having me.
So first half of 2026, what a year. Geopolitical instability, and yet the markets have been resilient. What has surprised you?
I think the resilience itself has been in some ways a surprise because if the start of the year, if you had sort of said we'd have a big geopolitical event and oil prices would almost double, one wouldn't have expected the resilience in equity markets that we ended up experiencing. But in some ways, perhaps not a surprise once you get into the weeds of it, because when it comes at least to US equity markets, earnings have really underpinned, the market returns that we witness. So yes, there have been pockets of stress, oil importing regions, energy importing regions like Asia. But I think US equity returns, they've been, in a sense, a surprise, but also, reminded us of the importance of earnings as a driver of returns over and above the headlines.
Now, diversification is often the mantra in uncertain times. In most times, in fact, what does effective diversification look like at the moment?
So I think beyond the standard parts of diversification, I think there are two things that really stand out today. I think one is within equities, reducing concentration in the AI theme. We still like it, and don't get me wrong, but we do think there's room for quite a bit of catch up in the rest of the market. So we think even within the technology sector, broadening exposure, but beyond that, even broadening equity exposure beyond the tech sector itself. We think that's a level of diversification that's interesting that we don't see enough of in investment portfolios. And second, of course, is looking to some alternative strategies, because yes, stocks, bonds, traditional diversifiers, but actually we start thinking of some of the more potential extremes out there. Alternatives like gold, like alternative strategies can really be quite effective.
So if we throw the spotlight forward to the second half of 2026, what are the big mistakes or the key mistakes that you think investors are in danger of making?
Well, again, a couple of mistakes which we think we've seen in the past and we see again, the risk of making. I think one is that concentration risk we just discussed, because there's still a massive temptation out there to chase a very narrow part of the market where the gains have been concentrated. But that's just like driving while looking in the rearview mirror. So we think that's one big risk. The second one, of course, is trading by the headlines. So there is quite a bit to worry about if you were to just read the headlines. But as we learned in the first half, the headlines and equity market returns can be very, very different things. So that temptation to stay in cash can be a second risk.
Well, let's talk about that temptation to stay in cash, because many people are succumbing to that and they do have cash. What would you say to them about that wait and watch approach?
Well, I'd just say at a headline level, history is not on your side. If you think about the first half of this year itself, global equities, the broadest, most diversified measure of equities, was up more than 10%. And even if one is not sort of up to taking on that level of risk, there are many, many opportunities to still lock in a much more attractive yield than cash. I mean, just looking at the bond market, for example, we like keeping maturity short, so you don't end up taking a lot, locking in investments for a long period of time. But once you start looking at the level of yield, you start looking at the credit spreads on offer, we think there are many, many opportunities out there across the risk spectrum that can still outperform cash. That's the lesson from history, and we just don't see a very different environment today.
So if you could summarize your approach to H2 2026 in a single headline, what would it be?
Well, I guess the headline itself is navigating through shifting sands. And I think the deeper headline for us would be, head into the second half with confidence, but always be nimble and prepared, for shifting sands under your feet. And I think that's where the diversification part of the portfolio can really help.
So Manpreet, we're here in Dubai meeting with a lot of Standard Chartered clients. What's been the most interesting or maybe even unexpected insight that you've gleaned today?
So, one of the most unexpected insights or discussions we had were actually around Indian equities, because that's where, there has been quite a bit of pessimism going into the last quarter, particularly, whether it's to domestic growth factors, foreign investor flows, or indeed the shock from energy prices. But I think the real surprise has been, the rising amount of optimism to say, look, if some of these risks start to recede, I think that optimism contrasts quite a bit with the market consensus pessimism. So amongst all the sort of different asset classes out there, I think that's the one which really jumps out.
Finally, let me ask you about psychology, optimism, caution. Do you think investors today are underestimating risk or perhaps even overestimating risks?
I think in the very short term, and I'm talking the next few weeks, there is a bit of underestimating of risks, because in pockets, as we discussed, concentrated areas of tech, there's quite a bit of optimism priced, and we do think we'll get a little bit of a pullback, which of course to us would be a great entry opportunity. Because long term, we think there's a lot of overestimation of risks. There's still the headlines which worry about what if oil prices went high, what if we had stagflation, what if earnings don't prove to be a support. But we think that's an excessive amount of worry. At the end of the day, we think about the big drivers of equities, which is earnings, think about the big driver of bonds, which is spreads and yields. We think they point to a fairly healthy set of returns ahead. So we'd rather be adding, leaning against that overestimation of risk.
Manpreet Gill, Chief Investment Officer, Standard Chartered EMEA. Great talking to you. Appreciate your time.
Thanks so much.
Oh.